We're going to go ahead and do our slideshow and Chapter 11, Risk and Rates of Return. Most important idea here is the greater the risk, the greater the return needs to be in order to attract investors. The question is, who cares about rates of return? Well, obviously investors do. And if you don't give them an adequate rate of return, they're going to take their money elsewhere. The rate of return needs to reflect how much risk they are taking, and they're going to decide whether to invest with you or whether to invest in a project based on how much return you're going to give them and how much risk they're taking. Remember, the return is always measured by cash flows and not by profits. Nominal versus real rates of return. We've talked about this before, but the nominal rate is the quoted rate of return, whereas the real rate is the nominal rate adjusted for inflation. And we're going to use a formula that is different than the one in the book because we're going to include what is called the Fisher effect. And so the nominal rate of return equals the real rate plus the rate of inflation plus a factor of real times inflation rate. And we'll be going over that extensively in class, so you just need to understand the concept and then you'll be able to actually practice calculating the nominal versus real rates of return when we get together in class on Thursday. Term structure of interest rates, you've seen this line before. This is the same thing as the yield to maturity. It means that interest rates vary as time periods vary. And right now, this is a yield curve that you would expect to see, that longer term interest rates would be higher. However, in the early 80s, when interest rates were 20%, 16, 17, 18, 20%, the yield curve would have been inverted at that point because no one expected the 16% interest rates to go on indefinitely. This is called the term structure of interest rates, or the yield to maturity, which you saw in bonds. The shape of the yield curve, as we talked, varies with expectations. The yield curve that's shown on this slide suggests that people in the long run expect interest rates to rise as the maturity of the investment vehicle is extended. So the longer you're invested, the higher the interest rate you're expected to need. Expected rate of return. This is determined by figuring out what the different possible outcomes are, weighting those, determining what the percentage chance of each one of those happening is, and then calculating the weighted average of all of those possible outcomes. You of course use cash flows to do this, and I'm showing you on the screen now an expected rate of return chart. There's also a formula, and I believe it's in the book, that shows you how to do this as a formula. The idea is that you take each scenario, best, likely, and worst, the probability of each scenario, the return for each scenario, you multiply the probability for each by the return for each, and that gives you the weighted return for each scenario. You sum that up, and that will equal your expected rate of return, which is often called the ERR, or expected rate of return. So, trying it ourselves, let's take a look at this problem. First of all, we've got a 30% chance of the best possible outcome, 40% of a likely outcome, and 30% of the worst outcome. The return for the best outcome is 12%, for the likely outcome is 6%, and for the worst outcome is 2%. You would then take the 0.3 and multiply it by the 0.12, and that would give you the weighted return for scenario marked best. You would take the 0.4 times the 0.06, and that would give you the weighted return for the likely scenario, and you would take 0.3 times 0.02 to get you the weighted return for the worst scenario. We will be going over that in class, so don't panic if it doesn't instantly gel with you. We'll have plenty of time to work with that. This slide is about the historical rates of return, and this is pretty fascinating stuff. Over the last several decades, stocks have returned an average of 11.6%. T-bills, which are considered the least risky, in fact, zero risk investments, U.S. T-bills, have yielded a 4% return historically, and T-bonds have yielded a 5.3%. So the question that the slides ask is, which one do you think has the greatest risk? Well, obviously it's going to be the one with the highest historical rate of return, and that would be stocks. Stock returns, there's some measures. The U.S. market has several indices. One is called the Dow Jones Industrial Average, and I believe that's 30 stocks. S&P 500 is 500 stocks, thereabouts. The NASDAQ, there's also the Russell 3000, which has all 3,000 stocks represented in it, etc. There's also some foreign market indices that the book talks about, or indexes, you can call them either one. And the Nikkei is a Japanese, and the FTSE, FTSE, called FTSE, is the UK. Recipe for estimating opportunity cost of capital for the market. You simply take your current risk-free rate, which is your T-bills that we saw a few slides ago, and you add that historical market risk premium of 7.6%. So let's go back and take a look at that. There we are. The stocks were yielding 11.6%, T-bills were 4%. The difference is 7.6%, and that difference is what's called the market risk premium. And that's all for rates of return. So now we're going to tackle risk. Risk, the big picture. Risk obviously is the variability of achieving a desired outcome, and that's measured by the standard deviation. Those of you that have had stats, and I know all of you have, will remember standard deviation fondly, I'm sure. There are two types of risk. One is firm-specific risk, which means it is related simply to that specific firm. So it would be related to Iroquois Group or Coca-Cola or Google or Apple or Groupon, anyone, any specific company. There's also market-related risk, and this would be pretty prominent these days based on the market crash of 2008, and that's where the whole market dives, and that is something you cannot diversify away. You can, the risk for a single stock investment is higher than for a portfolio of stocks. If you put together the right portfolio, you can actually eliminate all of the individual stock risk and end up with just the market risk. And we'll talk a little bit about that in a minute. You have to decide as an individual how much risk is acceptable to you, and each investor out there is making that same decision. What you need to know with regard to risk is how to measure it, how to diversify it away, how to price it. So let's begin with measuring. It's measured by the standard deviation of all of the possible outcomes. And the one standard deviation, as we've talked about before, covers 2/3 of the possible outcomes, and that's one standard deviation on each side of the mean. It can be measured for a single stock or investment, or for a portfolio of stocks and investments, and we will be going over how to do that in class. The variance and standard deviation, these are your definitions of variance and standard deviation. Let you have a moment to read those over. They both measure volatility. We're going to calculate the standard deviation in class, so you don't need to worry about that right now. Risk goes by many names. We've just talked about the two types, which was the firm risk and the market risk. Market risk is also called systematic risk, and single firm risk can be called firm-specific, unique, or diversifiable risk. So lots of different names for two different ideas. You can diversify away firm-specific risk by increasing the number of variety of stocks in your portfolio, and a properly balanced portfolio of about 20 stocks can diversify away the entire company-specific or unique risk of each of the stocks, leaving only the market risk in place. You can also allocate your assets to investments other than stocks, such as bonds and real estate, and that will help you to also balance or mitigate your risk. And interestingly enough, the book talks about, I believe it's this book, talks about 91% of the differences in pension fund results are related to asset allocation, not stock picking. So the stocks in your portfolio, you get 20 in there, you get the right 20, and you're probably just riding the market up and down. But more importantly, you need to look at how you've allocated your assets. And one of your investment vehicles would be stocks, but you would also have other investment vehicles that would help round out your asset allocation. You are still left with market risk, which we've talked about from 2008. We'll talk about that in class when we tackle individual and portfolio betas. And that is it for Chapter 11's lecture. From me, I believe Sean may be putting together something in the morning for you to also enjoy. Have a nice evening. Thanks very much for enjoying this video.